So welcome to another Edgewonk review, and today we have a special video because we are looking at a journal where the trader has backtested his trading strategy, and we're going to find out how to best use Edgewonk for backtesting, and we'll provide a few tips around that. And we are here with Moritz, my co-founder with Edgewonk. Hello, Moritz.
Hi, guys.
So this is quite an interesting journal where we can focus on a lot of other things. So this is a backtesting journal. And the cool thing about Edgewonk is that you can just create a brand new journal like you would for your regular trading, but you can just track your backtests here. And you can make use of all the great features and the tools that you have in your normal Edgewonk journal, but to analyze your backtesting trades. So we have 64 trades. He has a performance of 43%, and he has tracked trades for the last 9 years, roughly 8.5 years. What are your first thoughts here, Moritz?
Yeah, I mean, it's obviously a great proof of concept for the strategy here. It's over a decent sample size. It's very profitable, great profit factor, great Edgewonk score. Drawdowns look pretty good as well on the equity graph. So, in my opinion, great proof of concept. Now it's all about improving those returns because, in the same amount of time, the S&P is up, I don't know, something like 400% or so. So it doesn't really make sense to spend all that time trading if you can just invest into the S&P and make a lot more money. So we need to boost those returns either by increasing the risk, increasing our sample size, increasing our instruments that we trade, something along that line, I would say.
Yep, totally. When it comes to a backtest, this trader has tracked quite a few interesting things, which we can cover. He has tracked trade comments, which might not always be necessary for a backtest. You can save that time because with a backtest, you always have a little bit of a skew with the hindsight bias. You're often maybe a little bit optimistic on your trade, so you can save some time here. I don't think it's absolutely necessary to track the entry, exit, and trade management comments. This time that you spend here is much better used tracking other things as we will go through this journal, which we can show you. He has tracked the trade management, which is good. So you can compare an active trade management approach. So maybe this approach is using a trailing stop loss or some type of early exit. And you can compare to a completely passive approach, which we can do here. So potentially you can see the green line is above the actual performance, meaning if the trader would not have managed the trade or his trades, he would have made a little bit more money, 9R more. So there is a little bit more edge that the trader could have realized. So this is a very good thing to track in a backtest, especially if you have a trading approach that uses an active approach. So you can compare it versus a completely passive approach here. Another thing that you talked about is the drawdown. And I think analyzing the drawdown is always very helpful in a backtest. It can just give you some ideas of what to expect and if it's even worth going forward with this strategy, right?
Yeah, the return to drawdown ratio is really good here, 6.3. Professionals usually aim for 2 to 1 on an annual basis. So overall, 6.3 is pretty good. And I assume, I'm not sure, that this trader was risking 1% per trade, maybe. Can we take a look?
Yeah. So here's the
Yeah.
highest bar, and this is typically, that means this is the average position size for a trader.
Yeah, so 6R max drawdown is really good, I would say. Nothing to worry about on that front.
Another interesting thing I think to look at when it comes to backtesting is the consecutive winners, but probably the consecutive losers. So what is the longest losing streak the trader did experience during the backtest? And here we have one losing streak where he had 8 trades, 5 for one time, and then a few where you have 2 losses in a row. But this is the longest losing streak. Yeah, and this is a very important and helpful stat for a backtest in general, right?
Yes, definitely. One thing I also want to say about the time span, I forgot to say that in a backtest, obviously, it doesn't really matter if you if it takes 10 years to collect all those trades, but in a real trading environment, when you have to sit for 3-4 months without taking a trade, most people really do not have that patience. So that's where backtest and reality, when the rubber hits the road, usually diverge.
Yeah, when we look here at the calendar and we go into the annual view, you can see that there are like 5 trades in 2024. There have been a period of 4 months without a trade. 2023, even longer. 2022 was quite active, which is interesting. There were 2 years where he had quite a lot of trades. 2021, again, a very calm year. Same here. Same here. And then 2018 was another very active year. But again, you have 1, 2, 3, 4 months where you do have trades, but this is where you hit the long losing streak. So the longest losing streak was here. And yeah, this is very hard to pull off then in a real-time trading environment.
Yeah, definitely.
But it's good to know these stats from a backtest, and that's the purpose of a backtest too. You want to see what to expect if you would take this live. Does it make sense to take this live? That's why you do a backtest to see if this is a viable strategy that you want to trade in real time. And those are the metrics that you then consult. How many trades you have, how long is the longest drawdown, the longest losing streak, what is the period of inactivity. And those are very important stats to seek out in your trading journal. One thing that we noticed is that obviously he is a swing trader. He is going for a 2-to-1 reward to risk ratio. So his average winning trade is 2.3. The average loss is roughly -1. Unfortunately, he doesn't have exit analysis. So this is one thing that we can spend some time talking about, because when you go to the chart book, we went through some of the trades. And when you look at your trades here, for example, this the entry, stop loss, target, very often it seems like there's way more potential that he could have realized here as well. Entry here, exit on the long here, and the price would have gone up. And this is true for quite a lot of trades. Here, not so much, but we have seen this in a few trades that there is, or there seems to be a lot more potential for those swing trades that he could have captured. So for this trader, it would have been really interesting. And in general, I think this is a very good stat to collect, is the highest and lowest price. So when you're entering a trade in Edgewonk, you can enter the highest and the lowest price points for your trade, for the trade duration, or even beyond that. So for a swing trader, how would you go about capturing highest and lowest prices? Would you look for the end of the year? Would you just use a 12-month period? How would you go about capturing the highest and lowest price points here?
Yeah, the thing is, like for day trading, what I like to do with highest and lowest price is to really track, for example, if I go long, and then I simply see how far price would go up before it hits my stop loss. That's how I would track the highest price. But obviously, if you are in a swing trade, you might wait 3, 4, 5 years to actually for price to come back to your stop loss. So it takes a long time to collect that data. In that case, I would maybe go with the if you're going with the trend, the next high, for example. If you're trading pullbacks, maybe you can only wait additional 3, 4, 5 candles, something like that. But important is simply that you go with one thing. So you pick one thing, say 10 candles after I close the trade, I track the highest price, something like that. And then you can already see whether there's potential for price to keep running or not.
Yeah, good point. It's for the highest and lowest price, it's really about the consistency. You want to make sure that you always use the same approach for tracking the highest and lowest prices, so that when you then go to your analysis, you know exactly what the data tells you. So if, for example, on a swing trading approach, you use the next 12 candles, the next 12 weeks, if you're trading a weekly chart, then you know, okay, within the next 12 weeks, what would have happened. And by doing the highest and lowest prices on your trades, this will unlock the exit analysis graph. And this would have been really helpful because based on the screenshots, we suspect that there might have been more room. So instead of going for a 2-to-1 reward to risk ratio, maybe a 3, maybe 3.5 reward to risk ratio, that would have been really interesting to see, is this a viable approach? Because this would boost the performance by 75%, going from 2 to 3.5. So that's going to change the system and the performance significantly. So an exit analysis, the highest and lowest price, it's 2 data points per trade. Of course, the trader could still just go back and do that. So if he is interested in knowing that and estimating how he could scale it up and push his return, that is something that we would recommend here.
Yep.
We can go to the custom stats, which is always very helpful when tracking or when backtesting and tracking some data points. We looked through the different custom stats, and typically what you want to look for is underperformers. So are there specific criteria or cases where the system isn't performing? There are some bars and some instances where the performance is much lower than other bars, but the sample size, unfortunately, is never high enough to give a conclusive answer. So here, you have one trade when you look at here, you have one, but it's only 3 trades. So those are all data points that are not conclusive. You would not make a decision based on those sample sizes. Ideally, you want to have 30 trades. I think that's a good number to go for. But for the underperformers, there's nothing really here. What are your thoughts?
Yeah, I think, I mean, sometimes because you have a low sample size, that also means obviously that it isn't performing well simply because the sample size is low. So you definitely need at least 30 trades before making any decision whatsoever. And for this trader, I can see, because I'm a bit familiar with the strategy, I can see that he's only trying to take super duper triple A trades. And in a back test, I would say you could definitely loosen up a little bit and go into those B and C setups as well, because there's definitely some edge there. And that would also boost your overall returns in the end.
Yeah, and also it will be then interesting to see, is it then worth taking C setups? Maybe A and B is the way to go, but if you're deviating too far, that's
Yes.
might not. And this is what a backtest is for. You want to get as many data points as possible to then see how to go forward and what to take live and if to take this live.
Yeah, curiosity is what you really need to bring to the table for backtests, and not perfection.
That's true. How would you go about scaling up a strategy where you do have an edge? Clearly, he is making money. It looks solid on paper, but it might not be worth it at the moment. How would you go about scaling up a trading approach then in live trading?
Yeah, I would firstly to boost the strategy itself. There are 2 approaches. Boosting the strategy itself, you can look into more asset classes because you're swing trading, so you have a lot of time to look at a lot more instruments. Now, obviously, this is a backtest, so it's simply backtest more instruments. Yeah, I can see there's a lot of future metals. There's, for example, no energies, crude oil, okay, a few more currency futures, stuff like that, and agriculturals for sure. Then that's the first thing I would do. The second thing I would do, as I said, definitely look into those B and C setups as well, because there's 100% edge there, and just because they have a lower win rate doesn't mean they're not worth taking, because you still make money on them overall. And then the next thing I would do after you have collected data A, B, C, then you go into dynamic position sizing. You bet more on those A plus setups. All the trades that you have now in your journal are A plus. So instead of risking 1%, you could go for 2, 3%, depending on your risk appetite. Boost it a little bit like that. And then you can boost this strategy's performance to, I would say, 20-25% per year, maybe even more, which then is really good. And obviously, this is a really low effort, low time investment strategy. So you can just run it alongside other strategies, which then adds to your bottom line at the end of the year, diversification, etc. That's the second way to boost your performance. Those are the two things that I would do.
Makes total sense here. So I think overall it's a very good effort, a very nice example of how to use Edgewonk for a backtest. And I hope this gave the trader who submitted this journal, but also other ones who were doing backtests in Edgewonk or who want to do backtests in Edgewonk, some ideas on how to go about it. So thank you, Moritz, for your input here. It was really interesting. Thank you for your time. And yeah, for everyone else, if you have a journal you would like to get reviewed, use that button here at the top. It appears if you qualify or when you qualify. And we look forward to hearing from you.